I'm Jessica Nickell. Let's talk real estate. All right, everybody, how are we doing today? Man, we are living in an interesting time. I never thought in my lifetime I would live through a pandemic. We have people chilling up in outer space. I never thought I'd see the orange guy from Home Alone become our president, or war overseas, or so many mass shootings. Recently, there have been some spikes in rates and some talk about recession. I know it's a really bad word that we don't like to say, but I want to take the stigma away from that today. So I'm going to give you guys a little history lesson. We're going to do a little educating. Had you guys asked me 6 months ago if we were going to go into recession, I would have said no. Okay. If you asked me 1 month ago, I also would have said no. In the last 2 weeks, all the experts that I'm listening to on all the podcasts and the videos, they're saying, okay, maybe. I think maybe it's like a 50-50 kind of thing that we might be going into recession. So let's talk about it. Let's figure out what it means. Let's get prepared, how it can affect you, what you should do. First of all, I want to talk about what is a recession and what is a depression. Let's do some terminology and see what causes those things. A recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP for 2 successive quarters. Just 2 quarters. But what is the GDP and what does it mean? The gross domestic product is the total monetary or market value of all the finished goods and services produced within a country's borders within a specific time period. The GDP can be calculated by adding up all the money spent by the consumers, businesses, and the government within that given period. According to BEA.gov, the gross domestic product decreased at an annual rate of 1.4% in the first quarter of 2022. So, if we decrease again in the second quarter, we're technically in a recession because we have receded. But what is the difference between a recession and a depression? A recession is a downward trend in the economy that can affect production and employment and produce lower household income and spending. Okay, so we're receding a little bit. The effects of a depression are much more severe, characterized by widespread unemployment and major pauses in economic activity. But now I'd like to invite you for a little history lesson. The history of recessions in the United States. So, did you know? The very first recession in the history of our country was in 1983. The Reading Railroad failed, leading to other railway failures and a stock market crash. Banks suspended cash payments, leading to the hoarding of cash and bank failures. Fast forward 35 years, and then our country gets hit by the Great Depression. This was a collaboration of unemployment rates reaching 24.9%, the highest in our country's history, and a 10-year drought, which caused the Dust Bowl and devastated farmers. And we're talking Dust Bowl like a time period of no water and not necessarily the awesome brewery in Turlock, which you should totally check out. Plug. No affiliation. I just really enjoy their beer. Try the Taco Truck Lager. You won't regret it. Then we move forward to 2008, and we're going to talk about the Great Recession, which is the one that we all remember. I remember I was newly out of high school, and all these things were happening, and people were losing their jobs and losing their houses, foreclosure, unemployment, and so much uncertainty in the world. And this was the longest recession since the Great Depression. It was caused by corporate greed, subprime loans. You may have heard of people using the phrase got a pulse, got a loan. And that essentially means that if I went into the bank and I said, okay, I want a loan for $1 million, sometimes they would just give it to you and you can go spend it. People were spending money they didn't have. They're using their houses like ATM machines, where I have a house and I want a boat. So then I'm just going to refi and pull this money out, but I'm going to spend it. And then you raise your payments and you raise your interest rates, but you can't really afford it. So what's going to happen when your home value goes down and you can't make the payments and you can't sell it to get the money back? you short sale or you foreclose. You can't afford it anymore, so you probably shouldn't have done it, okay? There were stated income loans. Hey, lender, I make $600,000 a year. Perfect. Okay, great. Stated income, here you go. Take the money, enjoy your new mansion, and hopefully that works out. If you've heard of balloon payments, where you start making little payments, and then you have this gigantic payment at the end. Well, if you haven't been saving up and you couldn't afford it and you're barely affording the regular payments, then that's probably not going to work out either. And then there's ARMs, adjustable rate mortgage. So what that means is that you have a rate now, and then every few years it can adjust, okay? And it's usually on the incline, right? So these types of loans are really good for people who say, I'm only going to be in the house for 3 years, and then I'm 100% going to move again. The fixed rates are the best because this is your payment today and all the way to the end, okay? It's exactly the same payment every month, every year. It doesn't change. So if you have calculated that to fit within your budget, then you're always going to be good. So why a recession? What causes this to happen? So typically we see a recession in our history when the Fed raises the interest rates to slow spending. When prices are getting too high and inflation's shooting up too fast, they want to slow it down. So we need to recede a little bit. We just need to pump the brakes, back it up a little bit, but it doesn't mean we're all going to die. But for today, we're going to talk about the history of interest rates, okay? So going back as far as I could, in 1972, the average interest rate was 7.38%, which shot to the highest rate ever in the 80s. It went to 18.45%. That's like a credit card. That's like if you had a credit card for your house and you bought it with that, and that is like the worst thing that you could do, okay? Don't do that. Don't try to buy a house with a credit card. Dear God. After the Great Recession, since then, we've averaged somewhere between a 3% to 5% rate, which is really great in the history of rates. I mean, considering in the 80s, they were up to 18%, and averaging before that, they were like 8, 10, 7. We're still in a really good range, guys, okay, where it is affordable to borrow money. So the lowest rate that we ever saw was in December of 2020, where the Fed dropped it to a 2.68%. Why? Know why? The world was ending. People were dying. All the stores were closing. Restaurants were closing. You couldn't get toilet paper. That was a thing, okay? So the Fed dropped the rate to encourage spending. So we're doing this economics lesson today to learn about receding. Like it's like an ebb and flow, like an ocean. We just got to keep going back and forth. Otherwise, prices will go so high that you're going to get charged $1 million to live in a shoebox, which if you live in the Bay Area is kind of already a thing. In 2008, we had the Great Recession versus in the early 1900s, we had the Great Depression. Lately, I've heard more people talk about how it was more of a play on words, and then it really should have been a depression in 2008 because the economy was so greatly affected by all of the things that had happened. The Great Recession was a scary time. I didn't understand it fully. I was newly out of high school. I saw lots of people losing their jobs. I heard of people losing their houses, saw a lot of for sale signs, didn't really get it. Now that I'm older and I've done more research and I am a real estate agent, I understand what happened to the fullest. You don't have the people doing the jobs. The interest rates are high. Unemployment's high. That's going to create a recession and or depression. But what is the unemployment rate and how is it calculated? The unemployment rate measures the share of workers in the labor force who do not currently have a job, but that are actively looking for a job. All the people out there that aren't working and that are not actively looking for work are not calculated in these figures. It's just people that are looking to get a job. Then in April 2020, the unemployment rate was up to 14.7%. And as we know, what was happening during April 2020, shortly after the NBA was canceled and the world was ending because everybody was dying of the COVID pandemic. If you didn't know, I want to share something with you. You survived a recession in 2020. What? No, that was a thing. we really did have a recession in 2020. It only lasted a couple of months. So why so much talk about interest rates? Why do interest rates matter so much? Why are they always talking about it on the news and the finance shows? And why does it matter? Okay, so basic economics is based upon supply and demand. Okay, there needs to be a balance of supply and demand. Okay, so when people are demanding something and the supply is low, people can charge more because there's less available and people will pay more for it. Okay, if supply is high and demand is low, price goes down because there's a lot of something and people aren't going to pay as much for it because they can get it cheaper from the other guy. You know what I'm saying? Okay, like, why would I go buy it there? I can just get it on Amazon. There we go. California, housing shortage, high demand for homes. Prices go up because there's few homes and lots of people that want to buy them. Okay, so then me as a seller, if everybody wants my house and I'm the only game in town, I can shoot the house price up and people are going to pay it. I can charge what I want because the demand is high. Not a lot of competition out there. Okay, now if the supply is high and the demand is low, okay, all my neighbors start listing their houses for sale and there aren't as many buyers anymore, then the prices go down because, you know, Joe Schmo comes over to my house and he's like, okay, you're charging too much and your neighbor's charging less, so I'm just going to go next door. Then Joe Schmo's purchase power is directly affected by interest rate. Okay, so he was going to go buy my neighbor's house for less money, but then the interest rates went up, so he can't afford that house anymore because now his payment's a little bit higher. The lender who's letting him borrow the money is going to charge a little bit more for that money. Okay, I'm going to say instead of charging you 3% like I was last year, I'm now going to charge you 5.5% to borrow this money. So if you really want it, this is what you're going to have to pay. So he says, okay, well, now I can't afford that house. I'm going to have to go across town so that I can afford a house over there. Okay, his purchase price has been lowered. He will then have to buy a smaller house, look in a different area. So what about your uncle that tells you, well, I heard that the market's going to crash? Okay, well, I've been hearing that since I got licensed in 2015, and thank God we haven't gone into a crash, but we have receded. We got the ebb and flow, just like the ocean. It just keeps going back and forth, okay? The government has enacted more laws to keep, you know, lenders honest. There are so many more guidelines and standards. People get annoyed all the time. Oh, I got to send in all this paperwork. Yeah, well, they want to make sure that the world doesn't end again. So can you just like send in your bank statements? And what about the people say, you know what? I'm going to wait for rates to go down. Okay, people, well, I'm here to tell you that all the forecasts show rates going up multiple more times this year. Multiple more times, okay? It's already gone up 2 or 3 times this year. We started in January at a 3.5%. We're at a 5.3. It is May, okay? So if we're going to go up more than that, that's going to reduce your purchase power, okay? So if the money costs more to borrow, you can buy less house. How many people do you know that said, I wish I would have bought during the recession in 2010? Or, I wish I would have kept that house in San Francisco that I sold 30 years ago. And then maybe you hear your brother-in-law, Johnny, saying, well, I'm just going to wait for prices to go down because they're probably going to go down like they did in 2008, right? Well, there will be some correcting. There are some people that thought that prices were still going to keep going up forever and everyone was going to keep bidding $50,000 to $60,000 over list price, or if you're in the Bay Area, $300,000 over list price, or in LA, $1 million over list price, or 10, or whatever you're at. But it's not sustainable. At some point, people are going to say, I'm not going to pay that much for that house. Okay, I just can't afford it. It's just not worth it. I'll just stay where I'm at. So there will be some correcting. All the people that I'm watching right now and I'm listening to the webinars and all the podcasts about are we going to go in a recession? Right now it's kind of 50-50. But even if we do, they're saying it's probably not going to be that bad. It might last like a year, 18 months. So I recently learned something really cool. I was listening to the Brian Buffini podcast, which you should totally check out. The guy knows his stuff. And some of the best companies started during recessions. I had no idea. Some people really know how to spot an opportunity. So I don't know if you've heard of companies like Ocean Spray Cranberries, who When the going gets tough, the tough gets cooperative. Instead of seeing who could make the tastiest cranberry sauce when consumers were pinching pennies, 3 cranberry companies pulled their bogs and found success. So hey team, let's work together. Okay. Yellow Book, maybe you know them as Yellow Pages. The Yellow Pages gave struggling consumers an efficient opportunity for comparison shopping. Instead of wasting gas, or more often shoe leather, they could let their fingers do the walking in searching for the best of deals. Allbusiness.com has a really great article I'll link for you guys. Then did you know Hewlett-Packard, Hyatt Hotels, Airbnb, Venmo, Uber, Slack, MailChimp. The list goes on and on of these people that saw their opportunity and they just went for it. The 2007 to 2008 Great Recession saw the creation of several successful startups. Uber Technologies is one of them. The ride-hailing app was launched in March 2009 after the founders failed to find a taxi in Paris. Airbnb. Several months before the start of the Great Recession, these roommates were renting out an air mattress in their living room in San Francisco. Seeing any opportunities here? So, just because the market is changing, maybe something's receding, we got the ebb and flow, we're just experiencing some change right now. This is the perfect time for you to look for the opportunity for you to make your move. But recession, not a super bad thing. I mean, we've had bad recessions before, but the fact that we've gone through 19 recessions in the history of our time and we have figured it out, we're going to figure it out again. But here's the deal. You can sit and wait and see how things go and keep your pulse on the market and wait and potentially miss your opportunity. Or you can seize your moment and look for the right opportunity for you. And as long as you are conservative and it fits your budget, you can sell, you can buy. There are many, like if you are thinking, oh, I don't want to sell, my house prices are lower. Well, the house that you're looking at buying is likely also to be slightly lower. So you may get a good deal right now, but prices are still pretty steady. So you're still going to get a good price for your home. You just need an expert to come out and look at it for you to tell you what kind of equity you're getting. And as my dad would always say, the bottom line is, whether we have a recession or not, you guys just need to stay educated. You need to find an experienced advisor, someone who's out there doing the research, getting the education, who can relay it and share it with you. I genuinely hope to be that guide for you guys. Please stay tuned with me. I'm going to have more videos coming up where I'm going to share lots of real estate information with you. Sincerely, thank you so much for listening, and let's talk real estate again soon. Bye.